back. You're watching The Firm. The goods and services tax will replace a plethora of taxes that earn India 6.97 lakh crore rupees. That's 6.1% of GDP. And so, the panel led by Chief Economic Advisor Arvind Subramaniam recommends a revenue-neutral GST rate of between 15 to 15.5%. Now, that translates into a standard rate of approximately 18%, a lower rate of 12% for certain goods, and a demerit rate of 40% for certain luxury goods. Besides rates, the panel makes several important observations on the dual rate structure, on doing away with exemptions, and the creation of a common national market that will boost the Make in India program. Today, I've asked two GST experts to identify the highlights of that report for me. Joining me are Lakshmi Kumaran of Lakshmi Kumaran Sridharan and Harishankar Subramaniam of EY. Gentlemen, to both of you, a warm welcome. I'm going to start by asking both of you first to respond to the rates that have been put out by the Arvind Subramaniam-led panel. I've just detailed them. What do you think, Mr. Lakshmi Kumaran, of a revenue-neutral rate of 15 to 15.5% and a standard rate of approximately 18%?
Oh, these numbers are looking very attractive. The standard rate of 18% and the merit rate of 12% and the RNR of about 15%. But the assumptions made are that the precious metals will be taxed higher and exemptions for number of products and services will be removed, including healthcare and education. Now, these are politically sensitive subjects. On one hand, the government wants to give subsidy to the education sector and also give the exemption for the life-saving drugs in the case of healthcare. On the other hand, if you are going to charge service tax on a whole, it will be a very big question mark as far as the politically right or wrong. And similarly, if they go to the precious metals, if you are going to charge a very high rate, then the chances of smuggling and not paying the tax are very high because removal of this metal is always easy. Many countries don't charge high rates on precious metal because it's considered as investments rather than as a trading of goods. And therefore, these questions are very important questions. If these taxes are levied on these items also, then RNR will remain at 15%. Otherwise, it will go on inching up and up, in which case 18% may not stay at 18%, may go up.
I completely endorse the revenue neutral rate that the CS report has recommended. And in the current envisaged base, that's the best that you can get as of now.
Okay.
And what we need to guard against is that the moment you have a revenue neutral rate of 15, and the fact is on the ground, this could well be a two-rate structure or a three-rate structure. The fact is, if you want to keep the standard rate at 18, and which is what seems to be the political consensus, at least at the center, then the challenge is you really can't keep too many items at a merit rate of 12%. You know? And the report again points out that it's important that you keep the lower rate pretty close to the RNR rate to avoid the political compulsion of pushing more commodities into the lower rate. Because the moment you do that, then the higher rate will no more remain 18%, it could inch up to 20%. Further, I do agree the concerns that Lakshmi has raised both on healthcare, education, precious metals, but somewhere at some stage there has to be a give and take if you want a moderate standard rate, and that's the political call that they will have to take.
Okay, those are comments on rates. Gentlemen, I want from both of you the other highlights that stood out for you in the report. Mr. Lakshmi Kumaran, you pointed out the issue of exemptions. You spoke of education and healthcare. Arvind Subramaniam's committee has said in no uncertain terms that exemptions must go. It is said, and I quote, if the GST is to be a success with an uninterrupted value chain that facilitates compliance and a buoyant source of revenue, these exemptions must be plugged.
I very much agree and endorse the Subramaniam's report. Absolute no difficulty. There are many exemptions which need not exist. They should necessarily go. I am not saying that education or healthcare should not be taxed, but it is a very difficult political decision to tax. That's why I was mentioning about that.
Okay.
Now, coming back to the exemptions, I can think of straight away textiles, for example. Textiles have been exempt from payment of excise duty for long. And textile is one of the most complicated subject matter in taxation, especially on indirect taxes. In the case of cotton and other wool, etc., natural fibers, the fibers themselves are not taxable. Whereas in respect of polyester, nylon or polypropylene, etc., The basic petrochemical, caprolactam or PTA, is already taxed, and since the textile products themselves are exempt, it is absolutely getting into the cost. Now, the challenge to the court, to the government, is going to be to tax the textile sector uniformly a particular rate, whether it is a merit rate of 12% or standard rate of 18%, whatever may be the rate. This sector alone could contribute significant revenue, and it can also have an impact on this 18%.
So you've identified exemptions as the other highlight in the report, and under that umbrella of exemptions, you've spoken of education, healthcare, and sectors like textiles, which will be impacted by GST. Any other highlight, Mr. Lakshmi Kumaran, that you want to very quickly bring to the table and bring to our viewers?
The other one is regarding the metals, the ores, for example. They get the exemption, and now it will get taxed. Once it is taxed, then the items will get taxed at the higher stages. And the more important I am worried about is about the coal. Coal, which is attracting lower rate of excise duty at this point of time, will attract higher VAT or higher GST, but once it is charged and it is going to be used for the production of generation of electricity, and electricity being exempt, which is not being taxed at this point of time as of now, this becomes a cost. If electricity is taxed under GST, because they can actually charge GST on electricity separately, then again the cost to the consumer will go up tremendously. So therefore, coal is one more area where you have to address the whole issue very, very carefully.
Okay, Hari, evidently exemptions is the one area in that report that, has stood out for Mr. Lakshmi Kumaran, and the impact on various sectors is what he has detailed. What has stood out for you?
To me, what stood out was 3-4 things. First is that the report really goes into detail about the amount of distortion origin taxes bring in the manufacturing and distribution process in India, whether it's CST or other origin taxes. What is staggering is that 6 to 7 states, which are the biggest manufacturing states, to name Maharashtra, Gujarat, Andhra Pradesh, Tamil Nadu, 50% of those trade between the states are nature of stock transfer.
Yes, I read
now
that.
The beauty is when you have a stock transfer, there is a reversal on input VAT on the inputs on those manufactured products. That is one. Further, you have even some states like Gujarat and Tamil Nadu, where even if you sell interstate, other than the interstate 2% cost, there is further reversal on the VAT on the input side. So the distortion is huge, and this again is used as an argument for very strongly recommending the fact that we should not continue with this 1% additional origin tax, which is again a cascading origin tax,
right,
because this in the current form will apply on supplies, which could mean it could even apply on intercompany stock transfers.
Yeah.
So that's a very strong case that has been made, and though this has been a reality for many of us, to see those numbers are really staggering.
That's true.
The second is the pains with which the CEA has validated or rather analyzed the NFPIP report. It is primarily to assuage the entire state stakeholders of the empowered committee, and that's something which is good, because that creates a trust and really puts out in the open what is the way of arriving at the current revenue neutral rate, which is lower than the RNR of 17-18%, which even the second NFPIP report has put out. The third is the fact that the CEA very emphatically states that we should not go for a band of rates, because a band of rates will again create a problem of no common market, and the entire slogan of Make in India by making one India will never become a reality.
True.
The fourth is another bold statement. I would say the report has been both pragmatic and bold. Another bold statement is the entire design of the GST. And again, I allude to what Lakshmi said. Keeping electricity duty out is probably, people are not realizing what this could create as far as manufacturing competitiveness is concerned. And the entire fact of we are talking of rent seeking, parallel economy, cleaning up the economy, black money, and ironically you have both real property and alcohol outside, which are probably one of the biggest rent-seeking activities in our country, And petroleum again. Petroleum, with the fact that petroleum and tobacco are even today, even if they are within the GST, the state and the center has the power to tax them over and above under excise and any other tax, again begs for the fact that these should be within the base, Because if you really don't even bring it into the constitution like you brought petroleum, the chances of it again happening, at least me and Lakshmi won't see it.
Slim.
We won't see another amendment in the next 15 years.
Maybe not even me.
Yeah, Menaka, I think you might still see through it, but I and Lakshmi, I'm taking the liberty of saying Lakshmi too won't see this.
All right, gentlemen, we're out of time there, but y'all have both indicated to me in this conversation and otherwise that the Arvind Subramaniam report is a step in the right direction when it comes to GST. We'll continue this conversation over the weeks and months to come as GST becomes a reality for India, hopefully. But for now, thanks very much for your time, and thank you very much for watching. We'll be back next week.
The Firm, India's only show on corporate law, tax and audit matters.